Good afternoon, Peter Klein, Chief Investment Officer, ALINE Wealth, joining you on the 12th of November, 2020. We've got a bunch of slides to go through with you, so allow me to share my screen and we will get right to them. Here you go. So our take is that stimulus has taken over from basic fundamentals. Animal spirits have run amok. As we will show, earnings and stock prices, which are typically correlated with themselves, have run and become disconnected. That's a critical component that we're concerned about. Real assets have been in a long bear market. And of course, that's worrisome and opportunistic, because we believe in mean reversion, right? So that we believe that when asset classes go out of whack, that they certainly go back the other way. And we see an opportunity in the value and growth style, as well as international and emerging. So there are things that we are finding opportunities in. These are few and far between. Current conditions. This is a slide that speaks about where we currently are. I highlighted that issue I mentioned earlier with earnings and the S&P. As you can see, earnings are down 30% and S&P is now up 13. This is a few weeks ago. Here's a graphical representation of that same phenomenon, right? That doesn't look how correlated they typically are, right? And then look at this, the widest gap on record. Take heed, folks. This is a humbling of the pros. This is an interesting slide because it shows you that retail investors' favorite stocks, and there's a bunch of them that are well known to the folks over at Robinhood. And you look at those stocks in the portfolios versus other sort of hedge funds and mutual funds and the index, and a wide gap. This shows you the current price to earnings ratio of a bunch of different companies, and you can see how high some of these ratios are. This is one of my favorite or most scariest charts, I think, is that it shows you the price to sales ratio for the S&P 500 is at 2.3, very much above the mean. By the way, the OTC composite has an average price to sales ratio of 11.6. I can't even think about the absurdity of that. This is to revenues, guys, not to earnings, to revenues. Typically, that's closer to 1.5, 2. This shows you the number of companies in the Russell with a price to sales ratio above 10. Unbelievable. Now we have the risk premium. Well, actually, we don't have a risk premium. A risk premium is when you look at the return on stocks versus the return on a 10-year treasury. Now, I know the 10-year treasury is held artificially low because of the machinations of the Fed in the last couple of months, but this particular lacking of premium essentially says that you're getting that stocks are being treated as if they were a no-risk investment, and we know that's not the case. High yield, they're supposed to be, junk bonds are known as high yield bonds, and they're not yielding much at all. That's concerning because the prices have gone up. Remember, bonds are like a seesaw. When rates go down, prices go up, and indeed these junk bonds have gone up a lot. This is the CAPE. This has been popularized by the Robert Shiller of Yale, and that is a index that looks at the price to earnings ratio over a 10-year cyclically adjusted 10-year period, and it's a wonderful high R squared, we call it. It allows for correlation going forward. It gives you a predictive power, and the predictive power is pretty high on the CAPE because it's a longer term smoothing out of earnings. And this is showing that the prediction is that it should be much lower than it is, which would mean prices would have to come down. Now, this is the aforementioned at NASDAQ and the 11.8 average market cap to sales. This is Buffett's favorite indicator. Market cap to GDP, right? This is the big fat macro PE ratio, right? You take the entire market cap of all the stocks, that's the P, the price. You divide it by the earnings, in this case, GP, and then you divide it out, and that's what you get. And as you could see, we are now at the highest level ever. Probably why Mr. Buffett has not been buying stocks, has been selling some stocks, and has been buying some alternative investments in the gold mining space. Zombie companies, guys, that's a new term. That's going to be something you're going to hear when the history books are written about this period. We're going to hear more and more about zombie companies. And those are companies whose cash flows are lower than what it needs to service their debt. And you could see they're becoming the more and more of them, the higher percentage. These companies, how can they survive if their cash flows are not even enough to pay their debt, to service their debt, not to pay it off, to service it? Number of companies, a percent of companies that are non-earning. These are companies that don't make money. 54% of the Russell 2000 are companies that don't make money. I mean, I thought we invest in companies because they do make money. And this is the highest reading since 1990. So it's slightly up, almost more than that. Unbelievable. The earnings don't matter anymore. That's a question mark. It's meant to be a question, right? And you can see here how earnings have fallen pretty dramatically. And we are scheduled to go up a bit in next year, but obviously at a 28 to 25x multiple, we're not cheap. But maybe it's all about stimulus, right? And here's the stimulus number. Here's the amount of money supply that's jumped so dramatically this year. And that has implications to gold, it has implications to inflation, it has implications to debt levels. This is concentration. So we're looking here is how many companies are in the Russell 1000 index that are 14%, 5 companies are 14% of the Russell. That is a 2.1 standard deviation event. That's unusual, very unusual. High concentrations, frankly, worry us. Margin debt's another sentiment index, right? How many people are borrowing against their stocks for future purchases? I know the cost of those margin loans are low, but when you see high margin debt, folks, think speculative activity, think froth, think no one has fear. That's what this is telling you, and that's worrisome. This is a relative strength index, and this is showing you that the S&P 500 at current levels is somewhat oversold. This is technical stuff, and you could see when the support level of the RSI, it's called the relative strength index, is in line with or hugging the S&P, then you have good relative strength. But when you see this sort of disconnect, then that's sort of saying it's oversold or undersold in some cases, oversold and overbought. We're overbought now. Travel sector, you can see here how the travel sector has come down sharply, and restaurants. So we have some, evidence of some concerns. Debt levels look worrisome to us, and very much it should be concerning, as we've discussed in the past. 28 trillion U.S. federal debt, 80 trillion in all debt, negative yielding bonds, 17 trillion. We'll see that in a moment. Here's the U.S. federal debt. Here's the negative yielding. These are bonds around the world that are negative returns. You're guaranteed to lose money. 17 trillion of them, 25% of all bonds out there. This is going to go down as a defining metric in this era. Okay, where do we allocate assets today? What is a fiduciary supposed to do in this conservative with conservative long-term capital? Buy what's unloved, balance between risk and return, embrace robust risk management, and of course active management. Our friends at GMO come out with a 7-year asset class, a real return asset class, and here it is. And you could see that they are suggesting that there'll be negative returns for U.S. stocks and positive returns for emerging and value. And you could see here that international and developed and emerging markets are much cheaper than in US markets. That's why we're focused here a bit more. And this value versus growth discussion, which has become very constant, as you could see, small cap value, Russell value, all the value indices are down. These are all-time lows. And that's why we get excited, because we want to be contrarian. We want to buy what everyone else is selling. And you can see how different the big differential this is right here. Huge, biggest ever. This has to converge. This is called alligator jaws. This one will come down, this one will go up. Those folks in between get crushed. Here you see, of course, another one of those graphs to show you the standard deviation. We are at a 2 standard deviation event, and then some. Value versus growth. And here's the same kind of thing, right? So the valuation of US value is cheap. And again, by the way, value does go up, right? And it goes up big when it turns. So you can see here how the market, after being down, how it turned. I think we're going to see a value boom in the future, short term, next couple, 6 to 12 months. We're beginning to see that. So I'm looking at value right now. Don't chase the overvalue. This is an example of when you want to sort of buy the most loved stocks. They do stumble. When they stumble, that's when we want to pick them up. We don't want to chase. Concentration in large cap growth, and that's, again, to the aforementioned slide about the concentration issue that worries us. Value funds we talked about, and here the opportunity set that might present. And this, of course, shows you the largest versus the smallest stocks and the differential returns between them. So we do have a case for real assets. We believe that the government is spending, governments around the world are spending. M2 has jumped, as we said, and commodities and real assets have been in a bear market for 10 years. So we do believe there's an opportunity there we are inflationists. We believe that inflation will pick up, and we want to have more hard assets as we move forward. And you can see how commodities have fared over the last 10 years, one of the worst performing asset classes. So gold has performed better. We think it has more room to go. It's a core belief in our investing protocol. And dividends. We love dividends. There's a lot of cash out there from S&P 500 companies. Maybe it's time. Maybe they'll do some M&A when things normalize with the virus and the economy. Maybe there'll be some dividend increases as well. And as you can see here, the aristocrat index, which is the companies that are aristocrats, are dividend-paying stocks that have a 25-year track record of increasing dividends. Very special group of companies. They're down. It may be an opportunity for us. I know I went through that quickly. I wanted just to get it out there in front of you and give you some great thought experiments and some great charts. Of course, here at Align Wealth, we invite you to speak with us and go over your portfolio, your strategy, your financial plan. Look forward to it. Wishing you and all of you a healthy and stay healthy weekend and Thanksgiving period if we don't speak soon. Thanks very much.